Hi, welcome to this video today, which is all about Forex trading for beginners. Now, in terms of the problem I'm going to discuss in this video today, it's going to affect most traders that start trading and cause them to lose. It's actually a very popular search term online, which is Forex trading always goes against me. What most beginners find is they put on trades and they continually get stopped out. Even worse than that, on a lot of occasions, the trade is going to go back the way that they thought, and they're stopped out near a high or a low. Now, a trader actually was saying he had this problem to me. He's saying, yeah, I've been stopped out about 80% of my trades. If I do the exact opposite of what I think I should do, I should make money. The answer is no, he wouldn't. Okay. Now, I just want to discuss this problem in a little bit more detail. Now, a lot of traders who come in the markets fall for a certain illusion in Forex trading, which isn't true. And they do not understand probability, volatility, and noise levels. So I just want to go through these points on a storyboard in more detail, and they should help you not get stopped out so frequently. Okay, right, let's take a look at the points in more detail. Right, let's have a look at why so many beginners continually get stopped out and are unable to catch winning trades. Now, in terms of, I've written illusions, probability, volatility, and noise in relation to Forex price movement. And let's take illusions, right? First point. All charts look easy, don't they? They all look easy when you look at them in hindsight. All the trend following periods and all the periods of consolidation are obvious, and when they change, and reversal candles when they signify a move in the opposite direction. It's all easy in hindsight. Okay, but it's much more difficult when you try and do it going forward. Okay, now most traders look at the chart, see price patterns, they think that's the way to make money. It's an illusion of order. Okay, what you get effectively is, you've seen it yourself online. A lot of traders say that prices went from A to B to C, next they're going to go D, E. It's like a pattern. What happened in the past is supposed to predict what's going to happen next. Just doesn't work. Like I say, humans are unpredictable, and price action all the time is chaotic. You don't trade probabilities, okay? So you've got to be focused on kind of the here and now where prices are going to go. I'll come back to that a little bit in a moment, but pattern trading strategies, avoid. Traders also fall for the illusion of the 50-50 fallacy. They assume, correctly, the prices can either go up or down. So that's a 50-50 chance of being right or wrong. But it isn't, is it? Because there's volatility involved. And you've got to have a stop loss. That means that it's not a 50-50 chance, okay? Now, in terms of Forex markets, a lot of traders believe they're highly volatile. They are not highly volatile at all. Most of the time, they're moving by fractions of a percent in a day, okay? So what makes traders believe they're highly volatile? Well, it's leverage, isn't it? But leverage is not part of the underlying market. That's just superimposed by the trader. Obviously, if you're using big leverage, then prices will appear highly volatile. But they're not really. And this is an important point, actually, in terms of what most traders want to do when they come to the markets is use a lot of leverage to make bigger profits, okay? And they want to use stop losses, they want to protect themselves most of the time. But what they're going to do is they're going to make the fatal mistake of trading too short term, looking for too small a profit and having their stop too close. Now, if you think about short-term trading, and when I say short-term, I mean within a day, maybe a couple of days or whatever. And this is popular with beginners, day trading and scalping. Use an hour chart, use a 30-minute or even 15-minute or 5-minute chart. Now, when you look at those charts, they're all going to look roughly the same, orderly. But they're not, because the action in most days is just pretty chaotic, normal ebb and flow of the market. It's not just speculators in the market wanting to make money. There's hedgers wanting to hedge a position, for example. There's people doing money across borders, sometimes very big amounts. All those different transactions create the normal ebb and flow of the market. And that's only obvious in hindsight. If you trade short term, you will continually get stopped out. Your profits will never be big enough to cover your losses. So, in terms of too short term trading, avoid it. It's the big daily, weekly, and monthly levels that are important, the big supply and demand levels, not the small levels in between, like you see on an hour chart or a 5-minute chart. Okay. Now, traders put their stop in the noise. Well, if you're trading too short term, you're bound to do that. Or if you're using too much leverage, you're bound to get taken out of the market a lot of the time, the majority of the time. Now, another mistake traders make, and this includes traders who are trading longer term, okay, they put their stop in an obvious place. So they want to buy a breakout above resistance, and then either put their stop right behind the level that's broken or behind an obvious support level behind that. Well, if the level's obvious to you, it's obvious to a lot of other traders, and there'll be a stop cluster there. And there are professional traders who make it their business to go after those stop clusters. They'll take the stops, then the market will immediately reverse and go back the other way. That's why most traders who believe the market is against them, I think their broker took their stop. Broker didn't take their stop at all. Just professional traders hunting out their stops in the market, not the broker. Okay. Now, in terms of obvious, this also applies to trade entries. If you've got a breakout level that everyone's talking about, they think it's going to break, media's on about it, it's going to go through the level, then go to X level to Y level, it's probably not going to be a good level to come in through. And most traders on these sorts of trades will basically have their stop too close as well. So an obvious entry is wrong as well as an obvious stop. And I think a lot of traders, they want to trade the news, okay? They'll believe the majority view. It's herding. We're herd animals. We like to be with the majority, not on our own. So a lot of traders get sucked in doing the obvious with everyone else, influenced by the media, and then they lose their money. Most traders actually want to feel comfortable in the market and not do the contrary trades against the majority. And there was a trader once, Richard Dennis, one of the most famous traders of all time. He taught his traders, if you feel comfortable doing a trade, don't do it. Think about it, because it's probably the wrong trade. Okay. Now, in terms of this little summary, I think what you should do is, if you want to trade the markets, you've got to go for the longer term. Okay. And I mean, trade off daily levels, big daily levels, weekly levels, or monthly levels. If they all line up together, even better. Okay. Do not put your stop in an obvious place. It looks like you might be taking a bit more risk to go one level back from the majority, but you actually increase the chances of you winning. Okay, so your probability of winning is better, even though it looks like you're taking a little bit more risk. But what you should also do is never use too much leverage. Okay, that way you can use a slightly wider stop and hold trends for longer without trailing your stop up right behind the price and getting bumped out by just sort of minor retracement. And I think obviously you just don't want to do anything obvious in the markets. Trade longer term, trade probability. Okay, if you want to learn to trade correctly, patterns, forget them. Use strategies that are timeless, really, in terms of trading the here and now of price, which would be, let's say, a breakout strategy, or even a failed breakout strategy. or trade price spikes and look for them to fade. They're strategies that will work, okay? And they're not based upon prediction. And I think a lot of beginners, they come in the markets, they are lured in by people who just say Forex trading is easy. It's simple. It's not easy, okay? Anyone can learn to do it, though. If you want to win, hopefully these points will basically help. And in terms of the market, it's not out to get anyone. It's just there. And the people who are continually stopped out and think the market is against them are making some of the key errors that we have discussed. Right. Thank you very much for watching this video as per usual. Take care. Have a good day.